Good morning and welcome to the WBC PPP Update and Small Business Guidance Seminar. This is Steve Kenton with Washington Building Congress. And just briefly before we get started, wanted to make sure that we recognize our annual sponsors who are pictured in my box currently up on your screen. These member companies make it possible for us to put on events like this and other programs and activities we've been doing over the past year. So thank you very much to those supporting firms. We'll turn it over directly to our panel today. We have Bill Foote and Chris Vasquez with Aronson. And thank you very much, Bill and Chris. And let's go ahead and get the program started.
Sure. Yeah, you bet. Thanks, Steve, for having us. We're happy to be here and to give this session, which you see is entitled PPP Update. So over the next hour or so, we'll be talking about where we are now in terms of the Paycheck Protection Program. As we'll talk about, we're coming up on, not too far from now, we'll be at the 1-year anniversary of the CARES Act. And a lot has happened in the last year. We're not going to cover every single piece of guidance that was released. We don't want to torture anybody, but we do want to just cover the latest and greatest. So before we get going, we'll just, Chris and I will tell you a little bit about ourselves and about Aronson. Assuming that I can advance the slides, which is might be a big assumption this morning. There we go. Chris, would you mind just
Yeah. So hi, everyone. My name is Chris Vasquez. I am a partner in Aronson's construction and real estate group. I've been with Aronson for about 18 years and specialize in construction, financial reporting, tax prep, tax planning, tax strategy. We work on a wide variety of contractors, including, of course, general contractors, but also with trades. Our most prominent are going to be drywall, mechanical, electrical, but we also have a few number of underground utility, AV contractors, steel ornamental contractors, and some heavy highway. So clients range from 3 million to 150 million to 4 billion. So we've got a wide range of clients, and yeah, it's for the most part, we're in our busy season, and our heads are down, and we're moving forward.
And my name is Bill Foote. I've been with Aronson a little longer than Chris, coming up on 25 years. Aronson as a firm, we're coming up on 60 years, serving the Washington, D.C. metro area and the broader mid-Atlantic region. Core industry practices, obviously construction and real estate, but beyond that, government contracting, technology, nonprofit practices as well. I am a recovering auditor. I started with Aronson on the assurance side, and as a firm, we kind of have 3 core service areas: assurance, tax, consulting. I transitioned out of the assurance practices, years ago, and over to the consulting side. So currently, I serve our financial advisory services practice, and specifically, I lead our transaction advisory practice, which is largely M&A due diligence, financial and tax due diligence for deals, and then our disputes practice and our valuations practice. And so I guess the question then becomes, why am I here? So perhaps foolishly, I volunteered to join Aronson's PPP team. And so for the last year, beyond my normal responsibilities, with a team of others here at the firm, we've been diving deep into the PPP and assisting clients. So fun stuff. Here's our agenda. We're going to start just with a high-level introduction, and then we'll get into the recent Economic Aid Act. And from there, we'll get into some more specifics on second draw PPP loans, which a lot of companies are kind of considering or applying for as we speak. We'll talk about forgiveness applications and the forgiveness regime in general. Then we'll get into tax considerations as well as some accounting and reporting issues. We'll save some time at the end for Q&A. As I'm sure everybody's familiar with, in Zoom, there is a Q&A feature, a Q&A button, that is. So if you have a question, use that Q&A button. I think we want you to use the Q&A button, not the chat button. There's also a chat feature which you can use, but if you want to send us a question, try to use the Q&A. And we'll either address questions as we're moving along, or we'll hit them at the end. And let's see, a couple disclaimers before we go forward. Any views that Chris or I express during this session are generally our own personal views, not necessarily the views of Aronson LLC. And then another disclaimer, our intent is to provide a general treatment of this topic, the PPP update, and but we're not here obviously to give any person specific tailored advice. So if you need advice tailored to your specific situation, you should consult with a professional, whether that's a lawyer or a CPA like Chris or myself. Talked about the Q&A button, and then in terms of Q&A, one thing I'll mention is that I think I've done a lot of these presentations over the last year, and I think without exception, every time there has been what I would call a stumper. So there's some question that an attendee submits that is not easily answered. And it's part of why these presentations are kind of fun, but I think it's also indicative of where what this whole thing is, right? This is an unprecedented loan program for which the guidance has come out fast and furious at first and over time. So naturally there are a lot of gaps in the guidance and nuanced questions that come up from time to time. So I like to start with an overview. I think sometimes as CPAs and probably also from a borrower's perspective, we get caught up in the minutia and caught up in some of the detailed guidance. So I think it's good to just step back, if only for a second, to remind ourselves, what is the Paycheck Protection Program? Why did it come about? Right? So we're talking about a forgivable loan program established to assist small businesses who are dealing with the pandemic, right? Unprecedented COVID-19 pandemic. The intent is to help small businesses maintain their payroll, to bring back employees who they may have let go, and to cover overhead. In addition to the loans being forgivable, they're low interest rate, 1% interest rate, 5-year maturity. Now fast forward to the, I'm going to say this once and only once because it's a mouthful, the Economic Aid to Hard-Hit Small Businesses, take a breath, Nonprofits and Venues Act, the Economic Aid Act, which was part of the Consolidated Appropriations Act, December 27th of 2020. Okay, that essentially reopens the PPP, right, and adds $284 billion in PPP funding. And a couple carve outs, as you see on the screen here, for both first draw and second draw PPP loans. And stepping back for a second, I guess that's terminology that you'll hear Chris use and I'll be using throughout this session. first draw PPP loans and second draw PPP loans. So with this additional $284 billion of funding, we had the continuation of first draw PPP loans, and then also the introduction of second draw PPP loans. And under each of those two buckets, there's, like I said, a carve out for borrowers with less than 10 employees, or for loans that are under $250,000 for low businesses in low or moderate income neighborhoods. There we go. Okay, some notable dates. It's, you know, I think it can be a little interesting to look at the timeline. So as I said before, the CARES Act was signed March 27th of 2020. We have April 30th of 2020. This is when the IRS issued notice 2020-32, which I think threw almost everybody for a loop by saying that you could not, for federal tax purposes, deduct the forgivable costs, assuming you were getting forgiveness for the loan, which I think for a lot of people that was contrary to what they understood to be the intent of the law. And Chris will get into the tax, some of that tax considerations like that later on. June 5th, the Ppp Flexibility Act was signed, and this was really significant. Among other things, the Ppp Flexibility Act extended what we call the forgiveness covered period from 8 weeks to 24 weeks. Okay, and that was really huge, because over a 24-week time period, it really took a lot of the stress for borrowers away, because there was didn't have to sweat some of the details as much, because there was a lot more time to spend the money or use the funds. August 8th was the last day for PPP loans under the CARES Act. And then December 27th was the Consolidated Appropriations Act, okay, under which was the Economic Aid Act that we're going to be talking about a lot today. And then lastly, almost a year to the day, March 31st of 2021, that is the last day for first draw and second draw PPP loans under the Economic Aid Act. So those are just a couple dates. As I said before, there was a lot of guidance that happened in between. It was happening on a daily basis for a time, and slowed down, picked back up more recently with the recent legislation. And before we move forward and start getting into some of the details, as we like to do in these PPP presentations that we've given, we like to take a break for some trivia, some this day in history. So I'm going to throw two questions out, and if you want to chat, I guess, chat in your answers. If you want to venture a guess, feel free to do so. So here's the first one. So February 17th, this day in history. On February 17th of 1933, the Blaine Act was approved by the Senate. Okay, and the Blaine Act put an end to what? Anybody want to venture a guess? We'll give it just a second here. Chris, can you see the chat? I think I'm looking at the chat and I don't see any guesses coming in.
I don't see any guess either. It's a while ago. I don't know. The Blaine Act. I don't know that I've heard of that.
1933, the Blaine Act put an end to prohibition.
Oh.
End to prohibition. Very, very significant date. And then second one, little more recent, but still a Wayback Machine, I guess. So second one, February 17th of what year? Looking for a year that the Beatles released Strawberry Fields and Penny Lane, which was a, I guess would have been a 45 record back then, with what I understand to be 2 A-sides, not the traditional A-side, B-side, but they were both deemed to be A-sides. Anybody want to guess what year? Strawberry Fields, Penny Lane. Thank you, David Galen, for participating. But it is not 1964. Anybody else want to take a guess? Give it 10 seconds. Chris, want to take a guess?
I'm going to go with David +1, so I'll do 1965.
It was 1967.
Ah, okay.
All right, enough of that, I guess. PPP and the Economic Aid Act. Here we have a comparison of the first draw and second draw loans. And there's some important distinctions. Obviously, the maximum loan amount, we were talking about $10 million for first draw PPP loans. For second draw PPP loans, it's $2 million. And then obviously there's a higher threshold for an affiliated group, 20 million in the case of first draw, 4 million in the case of second draw. Mouse here, okay. In terms of borrower size to be eligible for first draw loans, 500 employees. For NAICS 72, which is the travel and leisure industries, you could use 500 employees per location. Or also there was a provision to use the SBA industry specific size standards. For second draw PPP loans, you're really targeting smaller enterprises, 300 or less employees, but again, for the travel and leisure industries, it can be on a per location basis. For individual borrowers, how do you calculate the maximum loan? Well, it's basically the same thing for first draw and second draw, average monthly payroll times 2.5, a factor of 2.5. So basically 2.5 months times average monthly payroll. Now, for second draw PPP loans, there's again another special provision for travel and leisure industries where they can use a 3.5 factor. What time period do you use to calculate your average monthly payroll? This is the same under either. You use calendar year 2019, calendar year 2020. Or the last 12 months. And then lastly, the gross receipts test, not applicable for first draw PPP loans, but for second draw PPP loans, you have to demonstrate that the borrower experienced a 25% reduction, 25% or more reduction in gross receipts. And we'll get into some of these details and definitions. Okay, so PPP borrowers, whether we're talking about first draw, second draw, right? You had to have been in operation as of February 15th. This says 2021. I apologize. That's a typo. That's Chris's fault. Joking. That's my fault. February 15th of 2020. And with the Economic Aid Act, we had an expansion of the eligible borrowers to include housing cooperatives, nonprofit news organizations, 501c6 organizations. And likewise, there was some clarification about who was not eligible. Including certain members of the government, entities listed on a national securities exchange. Everybody probably remembers the bad press that entities like Shake Shack and others received for obtaining PPP loans last spring. So entities listed on a national securities exchange not eligible, and then entities that are permanently closed. Another topic to, that I think is important to address, excess loan amount errors. I think this is often overlooked, but surprise, surprise, some borrowers received PPP loans in amounts, based on amounts that were not quite correct or didn't quite jive with the guidance. Understandable, given that the guidance was evolving. Those errors were made in good faith, right? Might have been the borrower who made the mistake, might have been the lender who made the mistake, but it was a mistake made in good faith. If that's the case, the excess amount of the loan that was received in error is basically has to be repaid, okay? Now, I just want to, we want to be clear that when we're talking about an error made in good faith, it's not the same thing as a knowing misstatement. So if we're talking about a knowing misstatement, right, then we're in a different area. They might result in governmental action. Documentation. When you're applying for loans, and this is generally, at least in part, specific to second draw PPP loans on the gross receipts test. We'll tackle that first. Borrowers have to submit financial statements or bank statements, and for loans that are less than $150,000, and there's at least in my experience, there's been a little bit of confusion around this provision. For loans under $150,000, documentation does not have to be submitted for the gross receipts test until the forgiveness application is submitted. But it doesn't mean that you never have to submit documentation of your gross receipts reduction. Okay, you just don't have to do it now. And then third bullet under gross receipts here, as you see, one of the options, like we said, is to compare 2020 to 2019, the entire calendar year. And if that's the case, you've got to submit tax returns, which I think for most borrowers, especially going back into January, they kind of said, well, how can we submit our 2020 tax return? We haven't even started thinking about preparing it yet. And nonetheless, you're required to provide basically a mock-up, and you've got to sign or initial it. So you got to submit a draft portion of your federal tax return if you're going to make that annual gross receipts comparison. For your average monthly payroll costs, this is things like 941s, information to support employer paid benefits. If you're a partnership, it would be your K1s. And then the last bullet on this page, I think this is kind of an important one, and one that has come up frequently over the last couple months, or a month and a half anyway. For second draw PPP loans, if you're using calendar year 2019 to calculate your average monthly payroll costs, and if that's what you used for your first draw loan, and if you're using the same lender, then generally you shouldn't have to submit that documentation again. Okay. All right, so let's move on to talk a little more specifically about second draw PPP loans. So as we said, that the maximum loan amount, $2 million, and the average payroll cost factor, 2.5, unless you're in NAICS 72, in which case you get 3.5 times. We can calculate our average monthly payroll, again, based on calendar 2019, calendar 2020, or 12-month period before the loan. What are average monthly payroll costs, or what are payroll costs, quote unquote, for this purpose? This would be gross wages and salaries, employer paid health insurance, and we now know that, where the guidance refers to employer paid group insurance, that it includes health or medical, dental, vision, life, and disability, employer paid retirement benefits, and SUTA. Okay, what do payroll costs not include? Don't include compensation to non-US residents. Also does not include compensation above $100,000 on an annualized basis, on a per person basis. So how do we define gross receipts? As with all of the PPP guidance, the devil is in the details. Gross receipts includes sales, it includes rental income, it includes interest and dividend income, it includes commissions income. So it may not be as simple as looking to your financial statement and kind of plucking off the revenue line. It may take the combination of multiple accounts on your trial balance. What do gross receipts not include? Sales to affiliates, capital gains, amounts that you might collect for another. And importantly, if you've received forgiveness on your first Draw PPP loan, that is not included in gross receipts. Just to be abundantly clear. And how do we measure gross receipts? The reduction in gross receipts. Again, it's got to be a reduction of 25% or more. So we can do this on an annual basis, or we can do it on a calendar quarter basis. So for instance, comparing the second quarter of 2020 to the second quarter of 2019. Okay, and it doesn't have to be all 4 quarters, it can be just 1 quarter. Or again, you can compare the entire year. And the measurement technique, right? The gross receipts, while it sounds like, at least to me, that has the kind of sounds like cash basis. Really, it probably comes down to how you prepare your federal tax return. The guidance points to the Code of Federal Regulations, which points to the SBA size guidance, which in turn refers to gross receipts reported on a tax return. So at a minimum, when you make these calculations, you want to be consistent period to period, right? If you're calculating gross receipts for the first quarter of 2020, calculate it the same way for the first quarter of 2019 and vice versa. But we also think it's a best practice to make that calculation on a basis that's consistent with your tax returns. And as it relates to the gross receipts, disclosures as you're applying for a second Draw PPP loan, the individual lenders may have their own forms that you have to fill out to reconcile your documentation to the claimed amount. So just something to be aware of. Different lenders will have different requirements, but the overall requirement is the same, 25%. So now we'll move along and talk about the forgiveness applications and the forgiveness regime. So we have 3 different options in terms of forgiveness application forms. We have the Form 3508, we have the Form 3508EZ, and we have the 3508S. And we'll take a look at an excerpt of these forms in a second, but basically what you see is that as you go from 3508 to the EZ to the S, the information that you have to submit is less and less. So for the basic full form, you have a loan forgiveness calculation form, you have representations and certifications, you have PPP Schedule A, you have a PPP Schedule A worksheet, whereas for the EZ form, as you can see, you basically just have the one-page streamlined application and then the representations and certifications. And I'll mention with the 3508S, originally the threshold for using that form was loans of $50,000. Now it's $150,000. So it's a significant change for smaller borrowers. And however, there's a exemption with that, potentially with that form, from the full-time equivalent calculation and the wage reduction calculation, and that threshold remains at $50,000. Okay, so talk about forgivable costs, and we've got this broken down into the legacy forgivable cost categories, and then on the right-hand side, the expanded forgivable cost categories resulting from the Economic Aid Act. And I'll say for a lot of the borrowers that we've worked with over the last year, as I kind of alluded to before, once the PPP Flexibility Act was put into place and the forgiveness covered period was extended to 24 weeks, some of the minutia of what you can and can't include as a forgivable cost became less important, because borrowers were no longer limited to an 8-week period, right, to use the funds. They had 24 weeks. So like I said before, sweating the details became a little less important for some borrowers, not all. In any case, the legacy forgivable cost categories, basically two broad buckets: payroll costs, non-payroll costs. Under payroll costs, we have cash compensation and non-cash compensation. Cash compensation, we're limited to $100,000 on an annualized basis. And there are special owner employee limits, which vary depending on whether you file your taxes as a partnership or an S corporation or a C corporation. In terms of non-cash compensation, talking about employer paid group insurance, retirement benefits, and state and local payroll taxes. The non-payroll costs include rent, utilities, and mortgage interest. And in the case of those non-payroll costs, just a reminder, these are subject to agreements that were in place as of February 15th of 2020. Okay, so if it's a lease, if it's rent, then it has to be pursuant to a lease that was in effect as of February 15th. And both rent and mortgage interest have limitations related to related party agreements. And just one other note on non-payroll costs, what the forgiveness application forms indicate is you do not have to claim non-payroll costs. Okay, so, and for some borrowers, they who used the money on just payroll or had sufficient payroll costs, that would apply. They don't need to claim the non-payroll costs. A couple other notes: the forgiveness covered period, right? Whereas originally we had an 8-week period, then we were given the option of a 24-week period. Under the Economic Aid Act, that forgiveness covered period is basically, they say it's anywhere between 8 and 24 weeks. Okay, so it's not like a binary 8 or 24. You pick 9, 10, 11, 12, whatever the borrower chooses. And there remains this 60% threshold. So the maximum forgiveness is limited by taking your payroll costs and dividing by 60%, right? Or to say it differently, you have to use 60% of the loan for payroll costs. Expanded forgivable cost categories. Covered operations expenditures. This basically, if you read into the details, this is basically specified types of software and cloud computing. Property damage costs from certain events, covered supplier costs, and PPP, not PPP, but PPE, protection expenditures. And then at the last bullet that you see on the right, like I said before, we now know that employer-paid group insurance includes not just medical insurance, but medical, dental, vision, life, and disability. So here are the Form 3508 and the 3508 EZ, basically a portion of page 1. And these forms have been updated recently. So if you happen to be just thinking about your forgiveness calculations now, and you downloaded the form, say in September, just be aware that in January, Treasury posted updated application forms. So you notice on the left, 3508, we've got 15 line items. 3508 EZ, we've got 12. What's the difference? Basically, on the 3508 EZ, you're skipping over these potential reductions for full-time equivalent reductions and also decreases in wages. And you may recall a couple slides ago, there was a third form, the 3508S. That's not pictured here. One, we didn't have room on the slide, but moreover, if you look at that form, other than the representations and certifications, really all you're providing on that form is the amount that you spent and the amount of forgiveness you're requesting. So you're kind of filling in 2 lines, and that's about it. So there's not much to show. So are you eligible for 3508 EZ? And in order to make that determination, you've got to be able to check one of these 2 boxes. Okay. Most of the borrowers that we've worked with are really looking at this first checkbox, right? You couldn't have reduced people's wages by 25%, and you see the "and" in bold letters here. And you didn't reduce the number, not the full-time equivalent, but the number of employees between January 1st, 2020 and the end of your covered period. All right, there's a second option, as you see here, which has a more qualitative option based on the borrower's level of impact from the pandemic. Document retention period, right? So this is 6 years after forgiveness, not 6 years from the date of the loan, but you've got to retain your records for 6 years from the date the loan is forgiven, or if it's repaid, then the date that it's repaid in full. So just a reminder. When we looked at the Form 3508, we saw that that included additional forms, right, or additional pages. And on page 1, it had the potential reduction for the Fte Reduction Quotient. Okay, so what is the Fte Reduction Quotient? Well, you kind of see our fancy graphics here, but it's basically it's a fraction, x divided by y, where x equals your average weekly FTEs during the covered period, and y equals your average weekly FTEs for one of 2 reference periods. Okay, and your reference period can be either February 15th of 2019 through June 30th of 2019, or it can be January 1st of 2020 through February 29th of 2020. And I think, again, in my experience, in our experience, in terms of assisting clients with their forgiveness applications, it's really this FTE reduction quotient that can be problematic, both in interpreting the guidance and also getting the proper information from either the borrower's payroll system or from the third-party payroll administrator. But wait, there's more. Okay, there's, you know, we have the rules, but then we have exceptions to the rule. So there are some safe harbors. First of which if you look at the form, you'll see a safe harbor 1 and a safe harbor 2. But there's also what we call a safe harbor 0, which means when you had no reduction of employees, again, between January 1st of 2020 and the end of your covered period. So that exempts you from that FTE calculation. And then there are 2 other safe harbors that apply. And I'm going to keep moving on in the interest of time. There are some exceptions. Okay, when you're calculating your FTEs, right? If you had a decrease in FTEs because you fired somebody for cause, or if somebody voluntarily resigned, you're potentially making an exception, and which has the effect of increasing your quotient, which would increase your forgiveness if applicable. PPP loans and SBA review. Okay, this was kind of a hot topic for a while. It's, I guess, still a hot topic, but as we probably all recall, there came a time when a FAQ was released by the SBA that said if you had loans of $2 million or more, that you would be subject to an SBA review. If you were under 2 million, you were deemed to have made the application in good faith. And so there is a form, really 2 forms, 3509, and 3510, which is a 15 page questionnaire, which seeks information about whether, whether there was a need for the loan. So again, that threshold is $2 million. If you look at the new form, the new questionnaire, form 3508, on that form, it distinguishes that $2 million threshold for first draw PPP loans or second draw PPP loans. So the question has come up, is this $2 million threshold a combination of first draw and second draw loans, or is it mutually exclusive? So seemingly it may be mutually exclusive based on the way the form is designed, but we're not 100% sure. Okay, Chris, I'm gonna turn it over to you to get into some of the tax considerations. If there's any, if you want to, add to anything that I've covered so far, feel free. And bear with us for a second. We're gonna use the Zoom technology if possible. Chris, I turned it over to you. Did that work?
Yes, it did.
All right.
Yes, it did. Okay. Thanks, Bill. Appreciate it. So the CARES Act, it had a ton of tax implications, and really there could have been an entire day of training and information sessions on the various components of the CARES Act. But for today, kind of what I figured is focusing on the tax implications of the loan forgiveness and a few other items, just kind of higher level, just to kind of put on your radar for when you're working with your accountants. So with that, let's go ahead and jump in here. Let's see here. So the first item is the PPP forgiveness of debt and the forgivable costs. So typically, whenever there is a debt forgiveness, there's this cancellation of debt income theory. Basically, if you were to go with a bank for, let's say, line of credit or some type of, let's say, equipment debt, and they forgave it, that would be income for you, your taxable income. But PPP loan forgiveness is this exception to this general rule. So that is a unique item of the tax. PPP loan forgiveness does not constitute as taxable income, so that's a pretty big win there. Well, IRS Notice 2020-32, which came out on April 30th of 2020, said that, hey, look, if your proceeds aren't taxable for the forgiveness, then you can't take the expenses that are associated with it. So in other words, if you are getting money from the government for free to pay your employees, then you can't take the wage deduction. My perspective is that's economically sound, because theoretically your company is only acting as a conduit for government cash to come through to pay your employees. So again, that seems to be economically sound. It's a net zero effect there. You don't get taxed on the cash coming in the door, and you're not getting the benefit of deductions for or cash going out the door to your employees. Well, in January of 2021, Revenue Ruling 2021-02 came out, and that Economic Aid Act that Bill said once, and he said the long version, I'm only saying the short version here. It said, you know what, you can take those wages that you're paying, that the employees are being paid, even though the government's taking care of it, we're going to allow you to deduct those wages for federal tax purposes. So while maybe it's not economically sound or fair, it is great for purposes of the owner of the company or owners of the company to get that benefit. Now they have the ability to deduct the wages that they otherwise would not have been able to deduct, decreasing their tax burden. And hopefully the idea is to kind of generate a little bit more operation, maybe some more investments into the company, to stimulate a little bit more economic activity throughout the country. So that was the idea behind it. I think it was a great win for the taxpayer, and I think it was a great win for all. In terms of, let's see here, the other tax considerations, one thing is the Section 199A, which is a qualified business income deduction, and there's an interplay with pass-through entities. So as a brief overview, Section 199A was a code section that was put into place in order to help equalize the low tax rates that C Corps were getting under the Trump Act. Basically, C Corps are able to get their taxable rates down to 21%. Now, while personal rates did decline, it just wasn't enough to keep it whole with the decrease in C Corp. So there would have been a theoretical, hey, let's jump from our S Corp or LLC, let's go into a C Corp now. So in order to equalize the C Corp rates, they created this deduction that you're able to put in your personal return that flowed through your S Corp or LLC to get this deduction. So that's the big overarching concept. There's not much to say with this with regards to the PPP, other than that this deduction is based off your taxable income. And because it's based off your taxable income, you just need to make sure that your forgiveness of debt income on your financial statements, your external financial statements, are adjusted for taxable income to not include that. So just a word of warning there, your accountant should know that. But yeah, just want to kind of point that out there. Second point, non-taxable forgiveness will increase partner/shareholder basis. So for business owners, let me just give you a quick, or the entire audience, give a quick crash course on basis. I don't want to get too technical because it gets pretty in depth and not extremely interesting, but basis is similar to kind of your cost basis in stock. It's a way to kind of track the ins and outs of income and expenses and other items accumulated throughout the duration of your ownership in your S Corp or LLC or other pass-through entities. So in these ins and outs, non-taxable income and non-deductible expenses were specially treated, and they're specially treated in this calculation of your basis and affect your basis calculations, your theoretical kind of your cost basis, you could say. Well, specifically for non-taxable income, you would not be able to count this towards your overall tax basis. So again, this non-taxable income, if you could think of it in a way of this money hasn't been taxed, so it can't reside in your basis calculation to increase your cost basis. However, under the Emergency COVID Relief Act of 2020, it does allow for this particular item for forgiveness of PPP debt to be included in your basis. So in other words, if you had, let's say, $1 million of PPP loan forgiven, then you would not, in the future, you would not be taxed on $1 million of your overall gain if you were to sell your company. So as you can see, this PPP will increase, the forgiveness will decrease your taxable income today when you get it forgiven. Then it also reduces the gain that you'll have when you sell your company in the future. So double whammy, extremely good for the taxpayer. Again, the overall concept is, look, we don't want to tax the taxpayer right now. Hopefully they'll reinvest. It'll help sustain operations. And in the future, hopefully it'll result in when they sell the company, maybe that less tax burden will have them rolling into some other type of venture that can help employ others. So that's the basis concept there. The third bullet point, state tax matters. Given that we're in the DC metro area, I figured, best concentrate on the DC, Maryland, Virginia effects of this PPP loan forgiveness. For DC, the loan forgiveness is considered non-taxable income. They conformed with federal. However, there's no specific guidance on if they're going to allow for you to deduct the wages or the qualified expenses or costs, rent or wages. They haven't come up with any specific guidance, so that's kind of up in the air. For Maryland, there hasn't been any specific guidance on anything, not on the taxability of the loan forgiveness, nor on the deductibility of the associated expenses. So Maryland is kind of up in the air. Virginia, well, so what they did is a bill was put through the Senate Committee on Finance and Appropriations, and that was put in January 5th. And essentially what this bill does is it would extend Virginia's conformity with federal law as of 12/31/2019 through 12/31/2020. So it's an extension of, hey, we're going to go ahead and extend this conformity with federal through 12/31/2020, thereby incorporating all the changes that Fed created with PPP updates. Subject to certain carve-outs. It's not going to be a one-for-one, but that's the overall idea. Now, the one thing that's kind of interesting is that you could think of is, and this has kind of been floated, I don't know that this will gain any traction, is if you think about it, if a state is not allowing you to deduct the wages for your employees, let's say we're working on a project, then theoretically, your job-to-day costs on a project are different for state versus than for federal. And theoretically, you could theoretically have a separate work in process schedule for state calculations versus federal. I don't think that will come into play, but this was a concept that was for federal treatment back when the Fed was not allowing the deductibility of wages or maybe indirect rent applied to jobs. So something to keep an eye out on. I don't think it'll happen. There was something similar back when with a bonus depreciation where you would theoretically have to have different work and process schedules. We never saw it come up as an issue under audit, but theoretically that would be pretty much the correct way to do it. Hopefully we won't see anything there.
And I think I'll just jump in really quickly, Chris. I think for a lot of folks, including myself, guilty of focusing almost exclusively on the federal tax treatment of the PPP, but the state tax treatment is important, and and it varies obviously, and it's kind of late developing. So just certainly be aware that there are differences state to state.
Yeah, absolutely. And in fact, with Maryland, their forms right now are kind of all over the place with some of these pass-through entity tax deductions. We're at a point right now as a firm, whether or not we extend anyone who's in Maryland, it's just so up in the air right now. We just got a notice yesterday that there's mistakes in their forms and they're fixing it. And so that's only further proving Bill's point. It's just ever evolving. Last point right here, point number 4, employee retention credit. So background on that, for 2020, certain employers were able to pursue a payroll tax credit if their operations were affected. Basically, the employer would compare their 2020 quarters with their 2019 quarters to see if there was a drop off. And if so, they were eligible for a fully refundable, which is great, a refundable payroll tax credit, so cash back in the door. However, if the employer had received the PPP loan, the employer was no longer eligible for this credit. Well, now under the Consolidated Appropriations Act of 2021, this is no longer the case. You can now have a PPP loan and apply for credit. So the act allows you now to go ahead and retroactively apply for employee retention credits for 2020 because they changed the law in 2021. You're allowed to go back and do these calculations and evaluate it. And on top of that, it expanded the employee retention credit for the first 2 quarters of 2021. So that's a great result. So an employer that did not take 2020, in summary, an employer that did not take it in 2020 because it received a PPP loan may now be eligible for those credits. One big caveat, though, for the audience here is that you cannot apply for the employee retention credit using wages that you use as your base calculations for forgiveness of loan calculations. So you can't double dip is ultimately what this is saying. Okay, let's see here. So in accounting and reporting, we'll shift gears here. We'll get into the financial reporting aspects of PPP. And so this is going to be for the benefit of external users. So think about your surety, banking, maybe states for their pre-qualification, and business owners as well. So this will be for their benefit. The good thing is that the PPP treatment is much more straightforward with financial reporting than with tax, where there are various implications for tax with all the various items in the CARES Act. Financial reporting really only has one major item to contend with, which is the forgiveness of debt treatment. So these are the kind of the options that you can use. Is accounted for debt under ASC 470. I'll get into that. Or accounted for as a government assistance by analogy to other guidance. There's an international accounting standard that I'll cover briefly, and then there's ASC 958-605, which is more of a not-for-profit approach, but we'll get into that as well. And then finally, the gain contingency ASC 450-30. Oh yeah, this is pretty important. No matter the method chosen, when you're doing your financial reporting, you need to disclose the accounting method and the policy used for those amounts. So the debt model here is pretty easy, pretty straightforward. Basically, cash in the door, record the debt. Once you record that, it kind of sits there until you draw on it, and then when the forgiveness comes through, then you record gain on cancellation of debt, or gain on cancellation of debt. This is the easiest way. This is the way we're suggesting our clients to do it. Doesn't require any brain surgery. once you get the notification that it is forgiven, you're done. So that's the way we're kind of suggesting. Again, there's multiple options. We don't want to tell our clients what to do, but we suggest, hey, this is pretty easy. It's just easier on your staff. It's easier for the auditors to kind of get through the information as well. So as you can see there, when we get the notification of loan forgiveness, we debit the loan liability and credit extinguishment of debt. Easiest option, just want to point that out once again. So under the international standards model, which we can apply even in financial reporting in the United States, it's kind of an interesting concept. What you do is you record a deferred income item. So for those who are not familiar with deferred income, it'd be similar to, let's say, overbilling. You basically, if you were to get cash in the door, but you hadn't performed the work, it's a liability until you perform that work. Well, this is similar. Deferred income is similar to that concept. And what I do like about this is that you record once those qualifying wages come in or qualifying costs come in with, let's say, rent or wages, as those costs are being incurred, so as timesheets are being filled out, you can record the income associated with what you expect to be forgiven. So that's pretty nice because it's almost like a matching of, hey, costs come in, okay, forgiveness comes in. So as this last point says, or second to last point, the income can take form as a separate credit line income as an other income on your financial or your P&L. Or what you can do is you can net it against your wages or your rent or other qualifying costs. So you would net down the amounts that would be included. So kind of a pretty cool alternative, I think. You've got a couple options within, and it matches your income stream. So the one thing I would note, under the debt model, which I previously covered, you recognize forgiveness of the loan on a all or nothing method, whereas here you'll go ahead and kind of ratably recognize the revenue, or ratably recognize the forgiveness portion. So as you can see, this is a little bit riskier from a projection standpoint from the client space. Are we really going to get it forgiven? And then you'll get your external auditors in there or accountants in there to kind of figure out whether or not this is truly going to be forgiven. So a little bit more heavy lifting from both the external accountants and the internal accountants from that aspect.
Which could be impacted by, is it subject to the SBA review? Is it not subject to the SBA review? A little more qualitative analysis, I guess.
Exactly. Whereas again, the debt model requires very little thought, really easy to kind of get through. No heavy lifting there. One thing to here, which is the international standards on this far right bullet point, that standard is to recognize revenue with reasonable assurance, which is similar to how we call probable in US. It's a standard that we have to go through, that the client would have to go through to figure out whether or not it's going to be forgiven. And it's a bit of a hurdle, but not too heavy of a hurdle. Now, this is the last one that I'm going to cover, the 958, ASCA 958. This really was for non-for-profit, and now it can be applied by all entities just for loan forgiveness for PPP. Again, this PPP stuff has been so unique that it's gotten so many special rules. The loan receipt, it can be initially recorded as a refundable advance. So with all of these models, every time it comes in, the money comes in, you record a liability and record cash. And then when conditions are substantially met, then you can record the qualifying forgiveness. So it's similar to the previous slide, but the issue here is that you have a higher standard to reach. You have to do the substantially met standard, which is a high hurdle. And the reason why this is difficult is because you have to consider things, these calculations aren't straightforward. And you have to consider things like full-time equivalents, hour reductions. While you still have to consider that in the international standard, You just have to have a higher burden of proof for the ASC 958, which is US GAAP. So definitely my least favorite. It's more stringent. You have to look at all the conditions of forgiveness, whereas with the international standard, you don't necessarily look as deep or as hard. And then there was one more that I didn't include a slide for, which was the gain contingencies standard. The reason I didn't include that is because that's been around forever, and those gain contingencies are extremely difficult to include on your financial statements. Gain contingency would be, let's say you had a lawsuit and you think you're going to win, and you want to book it now even though you haven't won it. There's a ton of things to get through, tons of hurdles. It's just too much work in order to benefit for the PPP aspect of it. So I didn't even include that. So in summary, I go ahead and suggest that you go with the debt model, which is the first one what I covered. You will really require essentially no work for you or your staff to pull together the info together, and it really doesn't require too much judgment. So again, I would go ahead and suggest that one.
Okay. Well, thank you, Chris, for covering the challenging topics. I got the easy part. You got the difficult part. Just that's the way I like it. So here are some links to some resources. You can find Chris's information on Aronson's construction and real estate page. And then we also have a COVID-19 page on aronsonllc.com with some resources. Treasury and SBA resources, these are just links to their general pages for the PPP, and also the loan application forms, those 3 forms that we discussed. Here's my information. If you have questions that you think of after the fact, feel free to reach out. If you have a question for Chris, feel free to reach out to him. And I think we have a couple more minutes. So if anybody has a question, I don't think there are any in the queue right now, but if anybody wants to throw out a question, feel free. And we'll Chris and I will stick around, you know, for 5 minutes in case anybody has questions. But again, on behalf of Chris, on behalf of myself and Aronson LLC, we're happy we could be here with you today, and we hope this was helpful.